So Lex, thank you very, very much for joining. I know you're super busy and super in demand, so really grateful to have you join the Crypto Curry live chat. I very much hope that soon you'll be back and able to speak or join us at a real life Crypto Curry where we can feed you curry in exchange for what you're coming. So thank you very much for joining. So we've got Lex from Consensys speaking about the future of finance and what's happening with finance, fintech, ETH. So, and Ryan, who was MD of Token Market, to ask all of the tough questions. So very grateful to have both of you guys here. And Lex, the space is yours.
The space is mine. Thank you so much for having me. And I've been meaning to participate for a while, and I know we've crossed paths in the physical space. And it's funny how life turns out. And so the first one that we're having is this digital format. But it actually, I think, makes a lot of things easier to say yes to. When you're in the Zoom world. Really excited to be here, curious to see where the conversation takes us. I think this last month and a half has been one of the most interesting for decentralized finance, and so I think there's a lot we can dig into depending on what you're interested in.
Fantastic. So yeah, apologies from the start because I know we've got Lex for an hour and I've got about 1 million questions to drive into, Lex. So if I am a little bit bolshy and rude and push you on to things based on the nature of the crowd and what they want, I probably will do that in this webinar because of the strict time limit we have. I thought maybe a good starting point would be maybe to go just a little bit more into your kind of background and obviously what you're doing now at Consensys, obviously one of the largest companies within the blockchain space, and just to kind of describe a little bit more around, what you guys originally set out to do, where you are now, and kind of your role within that. Would be great to.
Absolutely, yeah, happy to, and going to try to do that without the talking points because I think a lot of people know Consensys, and so how do you make that topic interesting? I think the interesting part for me is that Consensys is in some ways a mirror to what's happened in the crypto ecosystem more broadly, and its history is first as a venture production studio closely aligned with Ethereum, and Joe, who's the founder of Consensys, was a co-founder of the Ethereum project, an early funder, and sort of really built up a lot of that Cambrian explosion. And Consensys organized around that to formalize projects and startups and fund them and really be a safe space for crazy people in a good way. And I think the nature of that has changed over time as a number of startups and projects were created and funded, and then they needed to go to market. So then Consensys built out a sales and a services and a consulting business to essentially create a shelf space for all these ideas and try to see if there's demand for them. Go to large enterprises, go to startups, go to governments, and a lot of things in the background where these Ethereum projects landed with the large regulators or organizations focused on identity or relief or financial institutions. A lot of that was Consensys bringing solutions early to market. And as we went through that experience, you inevitably learn the types of things that are working and the types of things that are not working, and you also build this momentum from a services business to understanding, okay, this is a product. This product makes sense. People want it. Developers want it. Institutions are willing to pay for it. And so over the last 6 to 9 months, there's been a strong tilt for Consensys in restructuring and on the one side having a clean software business which is focused on helping people build on Ethereum. And so there's a lot of developer tools. There's DeFi tooling, working with financial institutions or with clients. And then on the other side, having its investment activities. And so I think this narrative is pretty complex and gets lost once in a while. But for me, it just reflects how blockchain is evolving. My role in that is twofold. I have 2 hats. The first is as the Chief Marketing Officer, and the second as I co-head this group called Codify, which is responsible for the fintech software offerings for Consensys. So digital assets, payments, swaps and markets, data and analytics. We have a number of modules that Codify builds. So that's a long intro to the concept, but hopefully that orients folks for the background of Consensys and kind of what I do there.
Fantastic. I mean, obviously in this whole market, we've seen almost this like compounded life cycle. I mean, you can almost say the Consensys, you know, at the start had, as you say, multiple projects. You probably had a few pets.coms as, you know, people were still working out what's possible, where the demand was. Then, you know, obviously kind of.
Yeah, not just a few. And I think this is true for all of the things going on, right? So if you look at 2017, there's a lot of pets.com or .io.
I've never seen narrative change so quickly within 2 to 3 months. And, you know, we saw it at Token Market as well, where we saw something that was, you know, fantastically exciting and then completely irrelevant within like a 6-month cycle. I've never seen anything like it.
On that note, Lex, me and Ryan were just talking earlier. What do you think is the next sort of pets.com or the next ICOs coming up? Obviously, there's a few things in this space that are changing. What do you think is the next trend that will just collapse?
That will just collapse. So there's a lot of things that are like in the slow burn type pace. So enterprise blockchain, private permission blockchain, for example, is in a multi-year slow burn process where lots of companies are building out these closed networks, then realizing it's expensive to run them, and now looking at public Ethereum and mainnet. So I think that's going to be a transition we see. Digital assets and this idea of regulated securities on blockchain, you know, token markets, securitize, a number of plays. I think we haven't seen the explosion and we haven't seen the collapse. I think, again, it's like the slow burn over time of, is it going to happen? Is it going to come in? I think that there are two places that are really expanding fast. Those two places, one is great and the other one is terrible. And so the one that's great is decentralized finance, DeFi. And it's great in the sense that it's just one of the most innovative things I've ever seen in my career. I've been in fintech over a decade, building out digital investing solutions, looking at, you know, innovation themes, digital transformation. And I just think the financial infrastructure that DeFi brings to the table is just aesthetically amazing and really new and exciting. There is the risk embedded in it of, let's say, recursive price movement, where basically things bounce off two walls and drive up a price of an asset without much going on underneath. So that's not good, but the actual technology is really compelling. But broadly speaking, I think DeFi is not going to pop or have the downside of the ICO bubble. I think the part that is really bad, and I mean, I think we all know this, but just don't talk about it, or maybe it's seen as like par for the course, is Ethereum is processing a lot of pyramid schemes.
Yep.
Like a lot. Like one chart I love is the stable coins chart of, you know, 8 billion, 10 billion or so of dollar cash equivalents on Ethereum. It's a great chart. But then when we look at transaction volumes and like where the money's going, like 50% of the Paxos stablecoin is used as money in a pyramid scheme. And that's not Paxos's fault. Like, they've just been co-opted. So to me, this is kind of like you've got malware on your network and you need to figure out a way to get rid of it. And so I hope all the like white hat hackers out there are going to go and blow up these pyramid schemes and return money to, you know, to their contributors, because it's just, it's rubbish to have that.
I mean, is that, with these kind of pyramid schemes, is this very much around this kind of almost CeFi type concept, where you have certain elements of decentralization, but really you have someone at that top of that pyramid who's building that structure out? Or is this, you know, driven by something else?
It's driven by totally something else. It's driven by a literal pyramid scheme. And I know I'm like kind of stuck on this because I have a newsletter called the Fintech Blueprint, and I did the research over the weekend for this, and so it's stuck in my mind. But for example, there's one called Triple M, and Triple M is it stuck with me because, you know, I grew up in the 90s. Before coming to the US, I grew up in Moscow, and there was a pyramid scheme during the time of the collapse of the Soviet Union called Triple M. And this dude printed vouchers, and you buy a voucher and you sell vouchers to others, and it's 100% returns per month. And I remember the advertisements on television in like 1992 for Triple M that defrauded, I think, something like 10 million people who had no idea what capitalism was. And so the person masterminding this is, I think, died 2 years ago, but set up this pyramid scheme again after getting out of jail in 2011, and now it's like infected Ethereum, and is 10% of all gas, I think, is spent by Triple M, and there's others, so
Sure.
like this isn't throwing an accusation against like Binance or like is Celsius DeFi like that? Not at all. It is literally we have a pyramid scheme problem that, again, going to the white, like, why am I talking about this? I want to champion Ethereum. But what I'd love to happen is for the people who are trying to figure out how do you pop open the honeypot of some DeFi protocol and hack it so you can double spend or whatever, like go do that in the smart contract of stuff that we want to get rid of.
Yeah. Well, I've been researching the crypto scams of late, and I mean, especially in Asia, they say for every person who's a crypto investor, there's 100 people who have seen people get rich quick and want the same, and it's just so easy to manipulate people into buying anything. So a huge problem.
Yeah, and I come at it from, like for years I've been defending Ethereum and crypto to say like, let's not distract ourselves with the sort of aside of scams and hacks and what, like all that's a distraction. The real thing is how amazing the financial infrastructure is, and this idea of digital scarcity and property rights, and this is next gen. And I find myself in this moment being like, oh wow, we need like virus, we need malware defenders. We need to get rid of the stuff that's literally sitting in our pipe and distracting people from the cool stuff that's actually happening.
It's a fair point. I mean, would you have any suggestions? I mean, do you need sort of a mysterious benefactor to be able to come in and offer bug bounties to be able to break these things open? Is there sort of a path you could see to sort of, allow this self-policing kind of white hats type way of sort of, moderating the market?
Yeah, so clearly there is no. Let me know, by the way, if my connection's bad, and I'll hop onto off the video.
You're okay.
But there is no way to police. This is the beauty of the network. I'm a proponent of the decentralized network, and so it's fantastic that it's permissionless and trustless. And like Pirate Bay, you can always get your Breaking Bad episodes. Like that's the good stuff. We like that. At the same time, like I think because we defend that so much as a core value, and especially I love the DeFi projects, and I think this non-custodial approach and the ability to do lending and investing, and I'd love to kind of switch talking to that, but like the ability to do lending and investing and banking and derivatives and insurance all in a trustless, permissionless way for people who have potentially no access to a financial system in their country of this quality, like I think all that stuff is great, but when you internalize those values of like fully permissionless is the best, and then you just say caveat emptor to like a disease that you have in the network, it's just the wrong approach, because you are going to inadvertently, you're gonna poison the mainstream adoption. And so like I love the idea that you're saying, which is, can we have bounties for like white hats looking for vulnerabilities in clearly known Ponzi schemes, because there are vulnerabilities everywhere, and I think people could fix it if they tried.
Okay, well, let's pivot to the more positive stuff, seeing as we've gone straight to where all the scammers are. And so let's go into some of the really interesting layer 2 stuff that's going on. So we have this explosion of these new kind of markets which have been going on, and obviously the ones which have been really hitting the headlines are the like of Compound, obviously some fantastic backers there. We've seen a huge amount of activity, the likes of Balancer and so on. Maybe it'd be good, because obviously it's still quite a confusing space. We love terminology in our industry of things like yield harvesting and throwing other terms onto things which maybe could be explained a little bit more simply. But maybe, Lex, you could give us a bit of an overview in terms of, what these things are about and what's kind of happening with the likes of Compound and Aave and so on.
Yeah, for sure. I think it really depends on the audience of how much background somebody has on this stuff. I think at its simplest, from a user or a consumer point of view, it's no different than what we've always seen, which is that people have money in motion, so they need to pay. And so you can use blockchains for payments and for moving money around. You can pay or you can bill somebody. Once you have money in motion, you end up having money at rest. And so that money has to sit somewhere, traditionally in a bank account or a deposit account or in a current account. Maybe it's generating some sort of interest for you in terms of savings. Again, in a traditional bank account, that would be powered by the bank, lending out money for economic activity. Once you have a bunch of savings, you might invest it in order to up your risk exposure to some sort of asset. And then longer term, you might also have retirement savings, and then you might buy insurance products for really kind of rare outsized events. You would also borrow in order to do intertemporal consumption, right? So you don't have money now, but you need to buy a house, therefore you borrow. So these are normal things that everybody does all the time, and for which there are lots of existing systems. And even in today's non-crypto economy, there are lots of layers of these systems of different age. So you can experience these activities using 1980s technology, or you can experience these activities using 2005 technology, right? So if you take your Apple Pay to a shop and you pay with your phone versus if you give somebody cash, there's centuries of difference in terms of the technology you use, but for the same use case. So now we're in the land of blockchains and DeFi. And so in the land of blockchains and DeFi, you have a invention of a shared set of standards and protocol in a network that allows you to have digital scarcity. So you can have a digitally native economy that you could never have before, right? So the internet's for media, not for the transfer of value. Blockchains are for the transfer of value. So you've got that first kind of bit in the payments leg of moving money around, but you don't natively have all this other financial infrastructure. And so if you think about an analogy, it's the manufacturing of the financial product, right? Like Revolut and Robinhood and SoFi and Venmo, those are all front ends. They're the distribution of the payment product or the investment product or what have you. How that the actual financial product is manufactured is kind of invisible to a lot of people. Like, what is really a bank account? What's a core banking system? What's a portfolio? What's a portfolio management system or an underwriting system? These are all nonsense words to most people. And that is precisely the part that DeFi is reinventing. Like, yes, DeFi has native asset exposure. You can have exposure to the comp token or to the balancer token or what have you, but it is the back of the industry infrastructure for exchange, i.e. trading, capital markets, for lending and underwriting, Aave and Compound, for money markets, for insurance, for derivatives. That machine that makes the financial product is being embedded as smart contracts, as software that self-executes on the blockchain. And if you're really not, you're looking at this stuff for the first time, you can just think of it as like, people are building these vending machines for financial products that are, you can interact with it, you put a thing in, you get a thing out. They're really transformation functions for value. And the super cool thing is that they all happen to be written in the same language using the same standards. So it's like, imagine you could go to Schwab or to some other, to Barclays, and when you buy a share of Apple stock, you can also buy a share of a private company, and you can also buy some sort of commodity, and you can buy a tokenized real estate piece, and you can also buy some foreign exchange currencies. And in the traditional world, this is really hard because everything rides very different rails, whereas in the DeFi world, it's all literally the same code and supercomposable, which then means your innovation cycle is 100 times faster, if not more, relative to like the fintech machine over the last decade. And that's the exciting stuff for me.
Okay. I mean, you covered a lot there, obviously, in terms of what's happening with these various different rails and being kind of combined within DeFi. is there a particular use case at the moment? I know it's still quite early, which you've been particularly excited by. I mean, you've got guys like Aave doing uncollateralized flash loans, which it just boggles the mind when you sort of go into it. Amazing, the use cases. Is there anything in particular that you've kind of seen coming out of that movement that you think is really going to be a game changer or really going to gain adoption quickly in a more broader market sense?
It's a really tricky question to answer in a straightforward way, because I just think the straightforward way is wrong, right? So like, here's the straightforward story. The straightforward story is, hey, well, there's two stories. The first one is government's trying to take your money, so move your money to crypto and get all the same services and do it in a permissionless and trustless way, right? So that's story number one. Question mark whether that story works in the Western world. I think it's fairly challenged, but in some places maybe that story works. Story number two, not only is it trustless and nobody can touch your money, but you can get a fantastic yield and fantastic interest rate on what you put in. If you give your money to Barclays, you'll get 10 basis points. And if you give your money to, at this point, not Maker, but Compound or Aave or somewhere else, you lend it out, you can get 10% or 30% in annual returns. And so therefore, investors that would like yield in the traditional economy should instead go to the DeFi economy to get yield there. So I think that's a straightforward story, but I guess I don't like it. I think fundamentally it's unsustainable, and it's not, to me, it's not the interesting part. And you can see this in terms of just how quickly these interest rates change. And the reason for why they change so quickly is because they come out of, like, the use case is basically margin. It's you have a market for borrowing and lending where the lending is motivated by somebody trying to take a long or short position on asset exposure to a token, not like, hey, I need to buy a house and therefore or I'm a company and I need to invest to build something. Rather, it is primarily an investment game. And so for me, that's why the interest itself isn't the motivating piece for why these projects are interesting, but rather like the fact that you could have an infrastructure for a margin trading desk, or the fact that you can have an infrastructure for trading, which doesn't require you to build a huge trading venue, right? So like the other thing about Balancer or Uniswap that's really cool is that they are able to match pricing for trades to like a Binance or a Coinbase. Like they can be as good as a centralized exchange. And by the way, you want your exchanges to be centralized, because that means the most people are there. It's like when you go to a supermarket and you want to get lots of things to cook your dinner, you don't want to go into the tiny bodega. You want to go into like the giant supermarket where all the stuff is. And that's what a centralized exchange is. That's where all the people are with liquidity, offering and buying and selling. But the DeFi projects have been able to replicate that through automated market maker capabilities, which is like an algorithm that sort of like synthesizes and stimulates this impression. And I just think these are really powerful innovations.
Sure.
You touched on the lending projects a little bit. You answered the question a little bit. Where do you see those going? Is it just too risky, or what do you see as sort of the real users?
Sure. So I think there okay, so there are a couple of directions it can go. One direction is like, hey, should I go buy the comp token, or should I do some yield farming, or should I invest some money into this? Be responsible. You should have an asset allocation. Part of that should be 5 to 10% crypto of your crypto portfolio. You should be primarily in Bitcoin and Ether. 5 to 10% of your crypto portfolio should be in crypto alternatives like DeFi tokens. The end, right? Like that's kind of answer number one. Don't lever yourself up 10 times on your credit card and then buy only levered up synthetics structured products. Okay, so that's kind of answer number one, and I think a bunch of people are going to blow up, and that's inevitable. That's just the nature of the internet. I think number two is a lot of that infrastructure, the DEXs and the DeFi lenders, they are there for professional or prosumer traders, like crypto funds looking for arbitrage, or people who are making a living speculating on prices, not in like speculation, not in a derogatory way, but just like factually people trying to take a position on prices. And so if you're not professionally or in a meaningful way dedicating your life to trying to speculate arbitrage out of the crypto ecosystem, then probably this is machinery that is too dangerous for you. You know, you're walking into a warehouse with lots of gears and you can get crunched. And so buyer beware. I think the third leg is some of this machinery can be tilted towards large scale institutional capital markets, right? So bringing additional types of assets to go through it. And second, it can also be tilted out of the capital markets use cases and for more day-to-day, like regular person economic use cases. You know, so going back to, I want to buy a house. I want to take out a student loan so I can get an education. People are going to pay that stuff back. They have known risk profiles and credit profiles that can be assessed. And so I think there's the opportunity to pivot some of this stuff to bring that economic activity on chain. And you know, so like Aave just did this yesterday, where their concept of, and these are all like crypto words, like what is it, like lending delegation or something like that? I mean, at end of the day, it's just you've got a legal contract in the real world, and the legal contract is going to be governed by, I want to buy a house, so you're going to lend me money and I'm going to pay you an interest rate, and I'm contractually bound to do that, and that has nothing to do with any collateral on chain. But then once we have the legal contract, we implement the underwriting on the DeFi protocol. And so to me, that starts to open up a really big space for innovation and pulling in the economic activity of things like Klarna and Cabbage and, you know, Stripe and all of these companies that might be doing, you know, merchant advances or all sorts of credit decisioning, bringing that on chain and having that sit on public infrastructure.
Absolutely, it makes sense. And I think it kind of brings us into quite a nice segue as well. We've obviously, since the COVID crisis, we've seen a lot of things accelerate in terms of remote working. We've seen a lot of disintermediation as well, direct to consumers, because we've had to DeFi, obviously, we've seen this massive explosion. And the conversation around central banking digital currencies has also, you know, come back to the fuel. We've seen the likes of Facebook launch a payment solution in Brazil and then get shut down really quickly across WhatsApp. It'd be great to understand your thoughts on where you see that progressing. You know, will that be accelerated? Will we see the first sort of central banking digital currency come out more imminently because of the kind of the pandemic that we're in? And where do you think that might be if that is the case?
Yeah, it's a fantastic time that if people are like sitting on the sidelines and deciding whether or not to enter this industry, like what a fantastic time to start. And if you've been in it, I think, at least for me, it's just renewed energy in terms of how there's constant waves of attention and new permutations of things that people are building, and there's just constant, like, all this vigor about the ideas in different permutations. And so even developments like the Chinese digital yuan or the, let's say, reconfiguration of the Libra consortium into like a closed loop payment scheme with a lot of regulation on top, those are things that are extremely constructive to the narrative because they create the pressure, like they increase the temperature across the world. They boil the water so that conservative institutions have to at least think or behave. Yeah, they have to at least pretend to be engaged in this stuff. And when humans look around and see other humans doing something, they copy it. And so the social effect is really powerful. Just last week, the IMF released like a 60-page study on retail central bank digital currencies. And maybe you've been in crypto long enough that this is boring and you're like newer to it, and like the central banks, it's just the banksters, right? Like there's that narrative. But who in 2015 would have thought that the IMF was going to generate recommendations for how central banks should launch cryptocurrencies? I mean, it's really fantastical. And so there are a couple of threads, which is that on the China side, and I think you can trace this across the whole Great Belt initiatives, right, into the Middle East and into Africa, is Chinese government owned or controlled or surveilled blockchain for both payments as well as supply chain, as well as like small business integration tracking. And I think that project is and will continue to happen. It's backed and pushed by Alibaba and Tencent and many of the large Asian fintechs that are spending, 50 billion over several years to invest in blockchain and AI. Like that's going to always be creating pressure. At the same time, I think we'll continue to see the Western tech companies developing fintech solutions on the distribution side. So Apple released a website where you can log in and look at your credit card and your spending. Like it's super weird. It's what a bank does. There's an Apple branded website that looks like a DeFi protocol. Like it's weird. And so these pressures will actually push regulators and central bankers to try and articulate what it is that will be allowed, right? And whether we like it or not, it's still a useful step to understand where the boundaries are. And so I think we've already seen some smaller jurisdictions launch what they believe is a CBDC. So Lithuania just recently had announcements. We know that small territories have done that in the past. And within the COVID environment, as you mentioned, it becomes more and more actionable. Where the concept of universal basic income and being able to ping somebody money immediately, that somebody being either a small business or a corporation or an individual, all of a sudden that's becoming sort of acceptable language for a central bank to say. Because just a decade ago, the concept that a central bank would hold accounts on the behalf of customers would mean that the central bank is disintermediating its national champions. And that doesn't really work. And today it's something that's on the table. So I think we are going to see that incremental change. The one thing I would caution though is that most of the benefit from this like COVID digitization change, I do think is flowing to the fintechs rather than crypto companies. So if you are Stripe, if you are Square, that's today who has those users. And so I think we just need to get through at least one more innovation cycle before the dots are connected.
What do you see realistically as a future for Libra? Where do you see that going? And do you see any of the big sort of giants trying to do something similar?
Yeah, I think, look, this is shooting in the dark, but I think it's not smart to bet against Facebook. They have a lot of people who hate them, and they've had a lot of people who hate them for a really long time, and none of that matters in any way whatsoever. They just continue to execute and kill everyone around them. Like, do you remember what Snapchat is? Because I don't, right? Like,
I remember the last recession when Facebook took a down round. And then absolutely blew everyone away. I remember working in advertising where they were being criticized for not having a mobile play, and then they took like 55% of the market in a 12-month period. I mean, Facebook can execute.
Yeah. And so I have a fear that Facebook and Libra will suck away the developers that Ethereum today has an advantage with. I think that will happen only if they get a special privilege to put lots and lots of crypto dollars onto the platform and then are somehow blessed from that. I think it's a low probability event. Much more likely is that Libra looks a lot more like American Express or like a Western Union, which is a closed loop payment system, which in it has stable coins, which are just, dollar backed or euro backed. I think that's the path they're going to go in. But there is this black swan chance that from a developer perspective, that a lot of people will rush to that user base. And it's not just Facebook, it's also Shopify, right? So in the Libra consortia is Shopify, which is absolutely crushing e-commerce in a crazy way. And Shopify is also connected to Stripe, I believe. A lot of their payments are powered by Stripe. And then Shopify also, I mean, if you don't know, Shopify is like a WordPress for independent online small business. And recently they flipped from being the WordPress to being the destination site, into being Alibaba. And so now on your mobile phone, this happened during COVID, you have a shop app which has the thousands and thousands footprint of independent small businesses integrated into it under the shop brand. That's way more dangerous than a social network of friends paying for pizza in terms of capturing payments flows.
Fantastic.
Cool.
I'm a little bit conscious on time, and obviously because your major employer, Consensys, they do work a fair bit on this protocol Ethereum. We've had some great news there as well. So 2.0, much lauded, waited for a few years now. We've seen some big steps and progressions. Almost dovetailing with the progressions of some of the layer 2. Whereabouts are we now with ETH, with sort of 2.0? We know it's sort of a number of different phases. How successful have you sort of seen that transition in the first one, which we've now seen the transactions per second go up to 1,500? And how likely do you think we will see staking as a service this year? That's a good question.
Great question. Here goes my advertisement. So disclaimer, the market commentary is that Ethereum had this early lead, captured a lot of developer mindshare, a whole bunch of Ethereum aspirants or pretenders, depending on your point of view, have sprouted up. Dfinity, Algorand, Cardano, you can keep, there's a running list of $100 million venture bets trying to take Ethereum down. And one could make the argument that some of those network ideas are more performant. However, conceptually maybe, but none of them are really stood up at the scale that Ethereum is. And so the amazing thing about Ethereum is, number one, it works, and it's worked for almost 5 years. And then number two, it's got the by far the best developer ecosystem of any chain in terms of commits, in terms of applications, and it's really, that's been its strength. That said, performance is definitely an issue, and like we were talking earlier, you can have one malignant application that all of a sudden eats 30% of your bandwidth, which is just unacceptable if you want to build real throughput on it. And so I think, at least from what I've seen, and I'm not technical enough to be able to pull this apart, but from what I've seen, there is a super solid architecture in place. It uses a lot of the learnings from the various protocols that we're trying to unseat Ethereum. And so a lot of the concepts that are familiar to people from proof of stake and from sharding and running multiple chains and so on, I think a lot of that's going to be implemented and integrated into Ethereum 2.0. From what I'm seeing, we have a very strong path to launch. There will be a launch this year, and there will be part of that, staking services that will be made available on a lot of the destination sites where people hold their assets, as well as potentially inside of wallets. So Consensys has right now, let's say, an early access program for our ETH2 staking private label service, which is part of Codify, the business that I run. So please reach out, codify.consensys.net. But we're not the only ones. There are a number of other staking as a service providers, and I think you're definitely going to see strong interest from the large consumer destinations to be able to offer that to their users. There's an inherent difficulty in the timing of the technology, in the sense that ETH1 and ETH2 are separate networks. It's not like you are just turning a screw in ETH1 and now it's got proof of stake and it's interoperable. Like, it is a different network, and it needs to be stood up, and there need to be ladders built for the migration of both value, right? So you send your holdings of ETH in the ETH1 network to some location where it gets burnt, and then you would get it on ETH2, right? So people are building all sorts of mechanisms to do that, but all the things that are supposed to sit on top of ETH2 down the line are not quite yet built. So you are making this transition to a new protocol, but you're not going to be able to really back out of it. So people are ideating solutions and figuring out how to manage this transition in an economic way, and how to preserve the innovation that we have in DeFi and make sure that it's interoperable. But at the very least, we are going to stand up the first phase of the network, and I think that's looking pretty solid. I don't want to say a date that I don't know off the top of my head, so I would just recommend folks check out consensys.net. There's a learn section, and we put out a whole FAQ on Ethereum too, which literally answers these questions, and the answers were written by the 30 or so research and development PhDs that we have working on this stuff. I'm overstating it, but you get my point. You would get a better answer from that source than from me.
Good deflection. So just on one more of those points, we've seen a few swaps previously, prior to Ethereum going from 1 to 2, and we saw it first time talking about that. Any time you're making this kind of transfer, getting the right information to people to do that swap is so hard. You have a number of different people who will hold their Ethereum in various different wallets, various different centralized exchanges, and then this transfer happens over a certain period of time, and it's ripe for fraud and for people to take advantage of this kind of uncertainty within this kind of market. Are there any provisions that are being put in place? I know it might not be particularly Consensys's role, but are there any kind of sort of motions to help facilitate a more smoother transaction for this swap than we've seen on other protocols, where, as I say, we've seen a huge amount of fraud?
So it's definitely early to have a substantive conversation on that, in the sense that this first phase is really just the stand-up of, does the core technology work, and can people, does staking work? Do the gears turn together? And so the early users of Ethereum 2 are very likely to be technical players. It's not going to be somebody buying a couple of tokens and interacting with it that way. I think it's going to be the institutions testing the technology in the waters first. So if I'm Coinbase or if I'm Binance, how do I feel? And I don't know, let's say I have X million of user funds in ETH1. I have to make a business decision about those funds and to interact with that network. And so it's really important to bring players, systemically important players like that, and make sure that the technology works for them, and that there's a plan for transition. I think longer term, you're absolutely right, which is, the memes on Twitter of not giving away ETH and stuff like that during the ICO bubble, for sure is going to appear again. And I hope that the industry does more than just say caveat emptor, stay vigilant. But at the same time, I don't have a tangible solution that I can propose. In the comments, I know some folks pointed out the diligence and transaction risk solutions like Chainalysis and Elliptic. So Codify has a module called Codify Compliance, which again looks at the same thing. It looks at the transactions inside of on-chain data, and then tries to risk weight which entities the money's interacted with, right? So if I know for sure that this stuff is coming from M, the Ponzi scheme, or if I know for sure that it comes from a hack, like a DeFi hack, and I know that, then I might have a warning, or I might have some sort of information that gives me the ability to choose what I do with that transaction. It's not KYC, but it's a way to warn people. But as you know, like most hacking today is not actually hacking something with a software crowbar. It is phishing. It is fooling a human being to take the wrong action in the real world. And I think that's a separate and more difficult problem.
That's fair. I mean, it's always seemed, because we're so early and we're so nascent, that having this self-regulatory type body in place is really hard to come by. With the press in the UK, we've had that for a number of years. But in blockchain, we have so many different alliances, so many different protocols being built on. At some point, one of the larger, real barriers of entry to a wider market is this issue of trust. And it does feel like, by building out in these kind of decentralized type ways and not having a centralized authority, you're not able to give that kind of trust. But we haven't quite found the solution in the industry to sort of abate that. I mean, in terms of obstacles of gaining that wider adoption, I mean, it could be argued, we look at transaction volumes there, I think 15 times less than they were sort of 18 months ago, but we still seem to be playing in the same sandbox in terms of consumers and people who are interested within this market. What would you say would be the things which are going to lead to wider adoption, to get more people interested in the space and genuinely using these dApps over the next couple of years?
So I'm definitely drinking my own Kool-Aid, because the data I have shows a different conclusion.
Okay, fair enough.
I only look at things that tell me I'm right. So Fidelity Digital Assets recently put out a survey. So Fidelity Digital Assets is the custodian arm of Fidelity for crypto assets. They are as conservative as a crypto player will ever be. Their survey said something like 26% of institutional investors that they surveyed, I don't know why their sample is like this, but 26% had crypto exposure. So whatever their audience is of institutional investors, that's really high relative to what I had thought. If you look at consumer exposure to crypto, it's gone from 5 or 10% during the ICO times when sort of I was doing research on this stuff, to now again in the 30s or 50s if you talk to people about awareness, and in the 30s if you look at holding of the asset. If you look at performance of the network, and so I have no comment on Bitcoin other than I think Bitcoin's fantastic. It's the store of value use case. It will store value, and that's great. I think Ethereum has won, for now, the world computer use case, or the operating system use case with applications on it. And the number I look at is contract calls executed per month. So, in blockchain computation, it's not software running just on your computer. It's executing against some sort of smart contract on chain across all these different computers. And so contract calls are now at something like 2 million per day, or 20 or 30 million per month. And that's a line that's going straight up, right? So like with Bitcoin, you're like, how much hash power am I using? Like, how strong is the network? How much mining is there? And that's what people look at as it wiggles. In Ethereum, it's like, is there software that people are running that's useful? And whether you like it or not, and whether the software is good or bad, there is just like strictly way more software that is using Ethereum for computation. And that's the only way that we're going to build applications and make them useful. I think there's a bunch of answers to your question around like a different user experience and removing friction and getting wallets to be better and getting rid of like abstracting gas and putting them into your iPhone. And I think all that stuff, at least by today, is like obvious, and it has to be done, and it will take time. But when I look at the fundamentals of Ethereum, it's not the same user base that we had 3 years ago. There's now 100 million unique addresses with I think like positive balances in them. So it's for me at least, it's definitely a bullish fundamental story.
Conscious of your timings, Lex, but there's a couple questions about what you think it would take for mainstream adoption.
For mainstream adoption, I think you have to go back to this question of what is, I think, at least in my mind, I separate out the mainstream adoption of the asset class from the mainstream adoption of the operating infrastructure.
Mm-hmm.
And so to get the asset class into portfolios, you have to take it and then normalize it and wrap it into traditional vehicles. And so we have exchange traded products, we have grayscale, we have all sorts of ways, structured notes, we have lots of ways that people are starting to bridge that gap and getting people to own the asset. And I think that's useful, and I think it's a motivator. I think the speculative aspect of cryptocurrencies is like advertising cost. That it's, you pay that price in order to get users.
Mm-hmm.
The operating infrastructure side is the much more difficult side, and I think it's also the less sexy story. And so honestly, that's a hand-to-hand battle over a decade. So like Consensys has worked on a number of projects with large financial institutions, and going from proof of concept to this is your production system is very, very difficult. We have a few examples for global trade, as does IBM Fabric, as does R3 Corda, but it is very difficult to integrate into all the existing systems and then to pull the use case into blockchains. And so it's a game that goes both ways, which is that gradually we increase the value that is native to crypto, which is happening. It seems naturally to be happening as there are more applications. And then we make boring and obvious and easier to use on the traditional side all this technology, so that, again, gradually there's an incremental sort of capture of middleware and back-end software for the large banks. And I think it just, I see positive progress, but it takes time.
So just to hold your feet to the fire a little bit, Lex, on that point. So if we separate the topic to more mainstream adoption, usage of dApps, are there any particular companies that you're looking at or have seen who you think have the potential to be that first, let's say 10 million user, 100 million user type platform, or even that first unicorn who does significant amounts of revenues?
I'll give you one right now. It's called Square Cash App. Generated 200 million of revenue from trading Bitcoin. The end. Like I think it's right there. I think it's slow, and then a lot at the same time, or whatever it is. Coinbase is 2 billion in revenue 2 years. I think you already have these things here, and the community is broad, and therefore there's this like negotiation of, is it crypto games, is it Decentraland, is it financial stuff? And the gamers will say the finance stuff's all speculation, and the finance people will say the games will never take off. And so that's just sort of how it is. I fall more into the camp of blockchains are for asset transfer and value transfer and native payment systems. And so for me, they're much more like a property rights system than they are like, I want to do Fortnite on it. And so the killer apps that are interesting to me, which today still have low user bases, but I think are massively promising, are things like Argent or Zorion, which are the apps that make the DeFi protocols very easy to use and hide the sort of capital markets machinery in fintechy UIs. So for Consensys, the answer for that is MetaMask. MetaMask has millions and millions of installs, and so for us, like that's our Revolut or our Venmo, but that's still a far cry from people using MetaMask to direct deposit their paycheck. So there's more work to do, but at the same time, there's definitely big successes in place.
Fair enough. So definitely no decentralized dating apps like Tinder coming anytime soon. Fair. Lex, I know you've got a really hard stop, so we have to ask the sort of the penultimate and most important question, seeing as you are talking at the Crypto Curry Club. What would be your favorite curry, Lex, if we were able to actually meet in person, sit down?
Easy. Saag paneer.
Okay. Are you vegetarian?
I'm not.
Okay.
Just a good cheese. That's all there is.
Okay. Fair.
Just a good green cheese. That's all there is.
Hopefully one of these days soon we'll be able to buy you a saag paneer.
Thank you. Well, it was a pleasure. Yeah, pleasure spending the time with you, and for everyone who dialed in, thank you so much for your attention, and feel free to reach out anytime.
Lex, thank you so much for joining us and for giving up your very valuable and in-demand time. So very grateful for you for joining us. Thanks for everyone who joined as well. But Lex, thank you so much. And Brian from Canada as well.
Cheers. Thank you, guys.
All right, take care.
Cheers.